because there was so little happening today. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of reciprocal. My trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is unchanged. Today is Tuesday, September 16th. It's the day before the Fed. All right. How did the market close? The market closed very unchanged. We're up slightly after hours. So currently showing is down 0.1%. I guess it was very slightly more than that. The Qs are down 0.05%, so very unchanged. And the IWM, that can't be right. The IWM is showing me at 0. Was the IWM ex-dividend today? And I just thought it was relatively weak all day, and I'm only realizing right now that it's not? Or am I having a weird print here or something? Somebody's got to fill me in on that. You have it down 45 cents. 0.45%. That makes a lot more sense. I don't know why my level 1 right here is saying unchanged, because I'm pretty sure we were down all day, unless there was an ex-dividend that I was missing. So that's a little weird. But yeah, VTF here, UVXY Bull, telling me that we were actually down 0.45%. So that makes sense. TLT finished up. Let's pull up that pre-market chart of the TLT real quick. TLT was the biggest thing that moved on retail sales this morning and moved down. But yeah, fully recovered that and closed positive. So interest rates still kind of grinding down. All right, so I don't really have a whole ton new to say here the day before the Fed that I haven't said already. Coming into today's trading session, the expectation was, I don't know. I had no conviction for today's trading session. I'm just waiting for the Fed. The day before the Fed is typically a very, very boring day because market participants at that point are not putting on a whole lot of new risk right before such a huge meeting. So seeing that the market, it did initially gap up. We had a little bit of excitement at the beginning of the day. It was exciting to see us sell down a little bit. We're looking at that SPY 660 to see if it could hold beneath it, break it. We're looking at yesterday's low to see if it could break it and hold beneath it. So we did get a little bit of selling of the gap up this morning. It was a decent gap. But after the first 30 minutes of the day, this turned into a complete nothing burger. From 10 a.m. to the close, the indexes were doing absolutely nothing. Qs are the same deal. Gapped up, sold down. We're looking at this 591 as gap fill support, but we then went sideways all day. The IWM, there was a bit more action here because it was very relatively weak in the beginning of the day and then was able to give a decent bounce back. But overall here, this price action was nothing, and that was kind of what we expected. I wouldn't have been surprised to see some de-risking in front of the Fed a little bit. I wouldn't have been surprised to see just a continuation of our trend higher, which was borderline going parabolic as of yesterday's close. And I'm certainly not surprised to see that the market did absolutely nothing. That would have been my base case for today. So nothing really to talk about there. And again, I've been talking about my thought process on this Fed meeting all over the place for days now, so I don't really have a ton new to add. But to sum it up, my thought process is that the market is fully pricing in, perhaps even overpricing in the Fed cut. We are going to get a 25 basis point cut tomorrow, and in my mind, there's one of two situations that really happens. We get a 25 basis point cut tomorrow that is coupled with dovish language, in which case I think that's priced in at this point. You might see on some dovish language a very quick uptick in the market. I think it eventually gets sold if that happens, though. You might see a quick reaction, algorithmic move higher on something that Jerome Powell says that's viewed as more dovish or a more dovish dot plot, but I think it gets sold. And the other situation that I think is possible is a 25 basis point cut along with either more neutral or more hawkish language. If that happens, I think the market gets toasted lower. So that's pretty much my thought process. I think that the risk is really to the downside with the degree of the move that we've had into this report. And there are a couple things that I want to note from like a market dynamics perspective going into this. One is that tomorrow morning is VIXpiration. So VIXpiration and OPEX are typically market dynamic related events that have a loosening effect on the market. So one of a couple of factors that we have noted for the month of September here that has been very supportive has been the degree of positive gamma in the SPX. So I think I read a Goldman note that described it as an 8 out of 10. I read a different note that I think also came from Goldman that said that this is accelerated to like $11 billion of positive gamma, so very, very insulating on the downside. On top of that, the other major thing that's been, well, there's been two other things that have been pretty supportive for this market in September. One is still the corporate buyback bid, but that is slowly disappearing as we go into the blackout period. And two is still the underpositioning and poor sentiment that comes from the discretionary community. The discretionary community, the hedge fund community, the institutional community, that's the one place that's really left to buy. The one cohort that I think is really left to buy. So I know I'm just repeating the same things I've been saying here. And it's interesting to see that a couple of you guys have provided information. I think Billy D put some information pre-market into the VTF, and I've seen this in a couple places as well, that the last week or so has been marked by huge institutional buying and huge hedge fund buying, huge institutional buying. So they have actually been buying a little bit, but they're chasing the rally. And it's incredible. They were probably the ones hating on the retail buying back in April, and now here we are 150 points higher in the SPY or whatever it is, more than that, working on 200 points higher in the SPYs, and now they're coming in and they're chasing a rally and they're buying the market up. It's just pretty incredible that hedge fund money in some ways has really turned into the dumb money. So they do still have some ammo left to buy. Yeah, I think that the risk is to the downside here. And the other market dynamic thing I wanted to note that I was spending some time really thinking about this morning is the vol control systematics. The CTA, the trend following community, the systematic community there, they're very far away from their sell trigger. We still didn't see an update from Goldman, by the way. We haven't seen an update on that number from Goldman in several weeks. I don't know why. Maybe the person at Goldman Sachs who provides that information is on vacation. But we did see from a Bank of America note, which I'm not as trustworthy of as the Goldman data, but we did see that for the SPX, it's like just under 6,400, basically back to September lows. So the CTA trend following systematic sell trigger, regardless, I could tell you, even without knowing Goldman's number, is very far away at this point. 200 points lower in the SPYs, more than that. In the S&P, even more than that. But what is a closer near-term risk that could be the beginning of what creates the feedback cycle is vol control. So if you go back to the chart that Bill was nice enough to post for us at 7:51 a.m. and you dissect that chart a little bit, you would see that we actually still had a bid from vol control today on an unchanged market, and we pretty much had an unchanged market. So there's a good chance that vol control actually bought an additional $5 billion worth of stock today. So it's impressive because they're already, based on Charlie McElligot's note from Nomura, they're already long at the 99.9 percentile on a 3-year look back. So they're still buying an unchanged market. We had an unchanged market. But what I think is more notable when we're going into an event tomorrow is the scale of the tails of selling in any degree of increase in realized volatility. So for today, and today isn't tomorrow, but I actually think that tomorrow might be similar. We might be able to see the number in the morning. Today, if we went down 1%, we would have been met by $18 billion worth of selling. If we went up by 1%, we would have been met by $9 billion worth of selling. And that increases exponentially the higher the percentage you go down or up. Why do I think that that's important? There's a big risk here, I think, to the downside. Um, and it really will help to negate the pop, right? So one thing I said earlier was if you get a dovish sounding cut from Jerome Powell tomorrow, you might see a pop, but I think that the pop will be short-lived. One of the reasons why I think that, and again, we should reassess this in the morning when we have our updated data, but I think it's going to be similar. One of the reasons why I expect that is because if the market goes up by 1%, you're probably running into, again, something like $9 billion worth of selling from the vol control universe. But if the market were to sell down by 1%, then you are also running into a large amount, maybe $20 billion, hopefully we see the number tomorrow, of additional selling that feeds into this. So circling back to the chart of the S&P, when I'm thinking about the risk of the event tomorrow, one, we bought up into the event so heavily, I have to think that not only is the cut for tomorrow priced in, 2 other cuts for 2025 are priced in, and 2 cuts for early 2026 are already priced in. So 5 cuts within the next, probably 6 months or so at this point, fully priced into the market. But 2 is if you can actually sell, and that's been the big thing we've been talking about for a while, if you can actually sell, it can really feed on itself. And one that does come from this vol control community into a pop on the dovish cut, you run into selling, which I think will negate any upside move, make it so that you can't really get a bigger upside move. But the risk here is to the downside. If you get that 1% move, it feeds on itself. I also think if you see a VIX pop, the options complex in the VIX right now, and the VIX levered ETNs and all that stuff can really accelerate the VIX higher at the same time as vol control in the SPX level can grind this market down. So I really think that there's a very big risk to the downside for tomorrow on this event. Doesn't have to happen, obviously. If Powell comes out and he's super dovish, we could get a pop that doesn't give continuation with it. That doesn't necessarily mean we sell off either. But if he comes out and he's more neutral or he's more hawkish sounding because we just saw a CPI that was at 3.1% for core inflation and is moving away from the Fed's target, and Fed cuts only can help to further accelerate inflation. If he says something along those lines, then I think that there's a big risk to the downside, because we're also even going into this with moderate upside extension, not extreme upside extension, but moderate upside extension in the S&P and the NASDAQ. So that is my kind of general thought process at this point, but we will obviously take it as it comes. I guess the only other notable thing is that the market is still pricing in a fairly muted move for tomorrow. Josh had just said that the implied vol for tomorrow is 80 basis points for the Qs, so not even a full percentage point, even less than that for the SPYs. It makes me like the idea. I probably should have said that in today's morning meeting. It makes me like the idea of owning volatility. You could maybe just own puts in SPYs or Qs outright. Josh here said that a Citadel customer bought 9,200 worth of September 17th. That's tomorrow. QQQ put spread for 584, 586 strike. We're trading at 590, 591.50 right now. So the break even on that is a down 1% move. But I think it's pretty cheap to own the downside or honestly even own a straddle. But I don't like the upside, because I think the upside runs into the vol control selling. So we'll see. But again, nothing really new insofar as my thought process. And yeah, you VIXy bull, you can own. That's the opportunity, actually, if you want to take a chance to ever own these crappy levered VIX ETFs. Buying them over the course of yesterday, today, maybe even still tomorrow morning in front of the event could pay. If it pays, it'll pay exponentially. So I think it's not a bad risk reward. But if it doesn't, the VIX, and this has been one of the things that we've been noting, but trying not to overread, there's been a divergence between the VIX and the market, right? The VIX has gone up for 2 days in a row with the market moving higher. I don't want to overread that because it's not unusual to see that right in front of a big event because people are buying insurance. So if this event is more like a dovish cut that I still don't think will accelerate the market higher, but maybe doesn't crash the market, you'll very quickly be seeing the VIX get crushed back lower, most likely. But when you think about, like a UVIXI or any of those crappy levered VIX ETFs, when they go, most of the time they just decay lower and trend lower forever. But when they go, you can get very, very fast short moves on these things. I mean, even in our little 2-day market sell-offs that we had the last couple of months, you had one VIX run from $14.70 to $18 in that's just a little 2-day down move in the S&P that gave that. Or back here in June, we had a little one where we went from 19 whatever quarter to 24 nearly again in 2 days. And those are just little 2-day sell-offs in the market because all that the market has given us since the April low is a 2-day sell-off. We're also going into the Fed tomorrow. Did the Qs close green? They did not, right? Qs were down small. We had 9 positive days in a row for the NASDAQ. That I guess that streak just ended with a very, very small negative close today. But 9 positive days in a row in the NASDAQ, everything getting extended to the upside on the index level. Vol control selling in a 1% move higher, but also selling in a big way in a 1% move down. The positioning risk, the flow of funds risk here is, in my opinion, very clearly to the downside, but it will still depend on how this event actually goes. And we will see just how dovish or hawkish Powell is. So that's all I got. I'm happy to answer any questions. TG like an SOUN. Yeah. I'm nervous to buy any new names, any new breakouts. You got to be careful. Like they've been running the long duration equities in a huge way recently, and they've made for some phenomenal breakouts. If Powell is moderately hawkish tomorrow and you see the TLT crash lower on it, then I think that those long duration stocks that have been leading higher could get hit down pretty hard also. So I would just be very cautious on new positions to the long side until we get through the Fed. You get through the Fed and the TLT is still holding in and those setups are still there in the long duration stocks, then we should go right back to buying them. But I think we should take a break for a day or so here on those types of breakout trades. What if no cut or they hike? That's not going to happen. That's not going to happen. I would say there's 0% chance that they hike, and I would say that there's a 0.5% chance that they don't cut. There's a slightly higher probability that they cut 50 basis points. I'd be more thinking about that. But I also really don't think it's going to happen. I think we're getting 25 basis points tomorrow, but not impossible for 50 basis points. But I don't think it's going to happen. And if that were to happen, I really don't know. That might be the situation where the market really does rip. But also, why are they like that? The flip side of that thought process is the concern on why they feel they need to cut 50 basis points. Are things really that bad right now? So I'm very confident we're getting 25 basis points tomorrow, and what matters is the language around it. Over into the YouTube from Cyril. Today the trade of the day was shorting SPY's pre-market in the London session at 662 spot 40, and then leaving the runner until the flush in the first 30 minutes. Okay, yeah, good trade. Most of what I did today honestly was pre-market as well. I shorted some Qs in the pre-market. I shorted a few of the names I'm already in. I shorted some Google. I shorted some STX. Shorted some NVIDIA, all pre-market, and was able to get some good follow-through on those. And we had a couple. We had barely any trade call-outs for the team today at all, just because the indexes weren't moving. We still had a couple okay intraday call-outs, like the SanDisk short. No, never really gave any follow through, but called out this RDR shooting star candle on the second 5-minute bar for SanDisk. Gave a little bit of follow through, but still disappointing. You still have an insane amount of extension in a few of these names. Micron had an inside day today. SanDisk made a new high, maybe gave a little bit of an RDR, but still closed very strong. WDC is another extension name that we're really looking at here that held in, and STX is another extension name that was joking around, is setting up for the Doji Burrito for continuation. Yeah, Tesla inside day makes sense and it's bullish. Time is a bull's friend for Tesla right now. It's just very extended. It needs to reset up. From Sebastian, on days like today where we can be choppy, is it better no trade setups? Is it better no to trade setups like the inside day and ARM, or not to trade setups in the inside day like ARM? Yeah. Or do you think it wasn't a good setup regardless of the market? No, so I think that ARM, I assume we're talking about long here. It's kind of a bull flag with an inside day. The ADMA is catching up. There's a moderate amount of extension on that chart that I don't love. I'd rather it be a little bit less extended. But I think it's a decent setup in a vacuum. But the market itself is such an important layer of probability, right? So you just, it doesn't mean don't take the trade. It just means that if you don't feel confident the market's going to be on your side today because we're right in front of the Fed, because the market's extended, what have you, then take the trade smaller is really what it means to me. Not to even not take it, but to take it smaller. From Cyril, I was surprised that EU stocks are selling off much more today. Also, today the Nikkei hit a new all-time high at 45,000, which was notable, but then pulled back. Shorting the strong market is not easy at all. Yeah, it sounds like some of the turmoil in France and everything is starting to impact the EU market a little bit, but I'm not as much of an expert in the space over there. From Steven, when reading volume, do you prefer to look at actual volume candles or do you look at RVol? Personally, I just look at volume. I just look at the volume candles. I don't look at RVol, but I know other people that do. So I'm not going to down it as a tool. I think it could be a good tool for you if you use it properly. I always say that volume is confirmation, but it's not necessarily necessary for a move, right? But it's definitely preferable when you have the volume confirmation to not having it. So it's kind of whatever I think you learn to use. I've always been good just looking at the actual volume on the candlesticks. Anything else, guys? I think a quick meeting today makes sense. I've been saying the same thing on repeat for the last few days. So I think everyone knows what my thought processes are by this point. And now it's all about waiting for 2 and 2:30 tomorrow. All right. JD. Yeah, I mean, JD, my thoughts aren't changed. Quite a great bid today, but it's relatively weak compared to Baba and Baidu. So I like Baba and Baidu better, but these are all too extended now. They need to reset up. They're all too extended. I think if you still have any of these long, you book profit. I think you book profit. Doesn't mean they can't continue. Momentum's a hell of a thing, but you book profit. Bank of America, banks in general, if we get a cut. So, generally speaking, interest rate cuts are bad for the bank's business because it reduces their net interest income. That should be fully priced into the banks at this point, though. I wouldn't be surprised if we actually saw the banks show relative strength compared to the market if the market sells at all on a 25 basis point cut. It should be fully priced in. There was a time there, it might have even been these 2 days here in mid-September, September 5th and 8th, I don't really remember, where the market was actually starting to price in a little bit higher of a 50 basis point cut, and the bank stocks did not like that. So if we're cutting too far too fast, that actually could be bad for the banks. Sometimes, not always, but sometimes the banks kind of trade opposite to the rest of the market on Fed days. So we'll see if that's the case tomorrow. I'm mentioning that a dovish cut should hold the market in best, and a hawkish cut should hurt the market the most. But a hawkish cut actually might be more beneficial for the banks. So there's a chance that on a hawkish cut you're seeing the market sell, but the banks hold up better. There's a chance on a dovish cut you see the market hold up a little bit better, but the banks are a little bit weaker. That would be my general thought process. Liam saying, what do you think about SoFi going into the cut last year? The cut was the catalyst for it to rip higher. Same exact thought process with SoFi, honestly, as the banks here. It should be fully priced into SoFi at this point, that cut. So pretty much the exact same thought process there, but except SoFi also trades as a little bit more of a long duration stock because it's a little bit more of, I don't want to say a startup. Startup's the wrong word, but it's a company that's in its growth phase as opposed to Bank of America and JP Morgan. They might still be growing, but you can't say that they're growth phase stocks. So SoFi may move with the banks a little bit for those reasons, but also probably moves with these more like IWM-ish type stocks would be my guess. Any impact to brokers like Hood and IBKR? It's the same deal. You know, the retail brokers make money on interest. When the interest rates get reduced, it squeezes them a little bit, but it should be fully priced into these things. So, similar thought process. All right, I'm going to wrap it up there. Have a great night, everybody. Tomorrow's the big day. See you then.